In 1895, the United States government found itself in dire straits, having virtually depleted its gold reserves. The Treasury vaults were alarmingly empty, and the nation stood mere weeks away from defaulting on its obligations. Amidst this looming financial collapse, with foreign creditors poised to dump U.S. bonds and presidential pleas to Congress falling on deaf ears, a singular figure emerged. John Pierpont Morgan walked into the White House and, with what amounted to a mere telephone call, orchestrated the solution. Crucially, Morgan's intervention was not primarily driven by a surge of patriotism. He saved America because his vast financial interests were so deeply intertwined with the nation's economy that he simply could not afford to let it fail. By 1912, Morgan's reach was staggering. He controlled an estimated 25% of all wealth in the United States. This wasn't just 25% of the banking sector. It was a quarter of everything. Railroads, burgeoning steel mills, vital shipping lines, established insurance companies, a myriad of banks, and numerous industrial corporations. A subsequent congressional investigation unveiled the astonishing scale of his influence, revealing that Morgan and his partners collectively held 341 directorships across 112 corporations, boasting combined assets of $22.2 billion, a sum equivalent to an astounding $670 billion in today's money. Yet, even this formidable figure understated his true power, as Morgan's sphere of influence stretched considerably further than what he directly owned. When Morgan spoke, markets reverberated. When he chose to invest, others confidently followed. And when he refused credit, companies withered and died. The sophisticated framework he painstakingly constructed, the banking structures he meticulously designed, the crisis management playbook he perfected, and even the Federal Reserve he conceptually shaped, did not simply vanish with his death in 1913. Instead, they evolved, spread their tendrils, and continue to control aspects of your life right now in 2026. Consider your mortgage. It likely flows through a system that bears Morgan's indelible mark. The colossal financial crisis bailouts of recent memory echo Morgan's 1907 playbook. The too big to fail banks, a modern fixture, are direct descendants of his sprawling empire. Even the Federal Reserve, the very institution that prints your money, was conceived in a clandestine meeting held in Morgan's private library. And when the next financial crisis inevitably strikes, it will almost certainly be navigated using the very tactics Morgan pioneered over 130 years ago. J.P. Morgan didn't merely forge a banking empire. He engineered the fundamental architecture of what we now recognize as crisis capitalism. This is a model where financial institutions become so immensely large and intricately interconnected that governments are left with no viable alternative but to rescue them. It's a world where private bankers can effectively dictate terms to elected officials, and where the decision of a single powerful individual possesses the capacity to either salvage or shatter an entire economy. You cannot escape it because the system is not J.P. Morgan, the man. The system is the established method, concentrated financial power, the exploitation of crisis as opportunity, the strategic capture of government influence, and too big to fail as an explicit, undeniable strategy. Let me now illuminate precisely how Morgan meticulously built this system, how he masterfully leveraged financial panics to consolidate his immense power, how he quite literally created the Federal Reserve in a secret meeting, and why. 113 years after his passing, you still navigate a world fundamentally designed by Morgan. John Pierpont Morgan was born on April 17, 1837, in Hartford, Connecticut. His father, Junius Spencer Morgan, had already established himself as a highly successful banker in London. This familial background is critical to understanding Morgan's trajectory. He was not a self-made man in the traditional sense, but rather an inheritor of an already formidable banking network. However, what he subsequently achieved with that inherited network, the unprecedented power he concentrated, the enduring system he meticulously built, was undeniably a testament to his unique genius. At the young age of 19, Morgan joined his father's banking firm in London. By 23, he had expanded the family's reach by opening the New York branch of his father's bank. And at 34, he forged a pivotal partnership with Anthony Drexel to establish Drexel Morgan and Company, a firm that would later evolve into the illustrious J.P. Morgan and Company. From the very outset of his career, Morgan's astute perception was that true power lay not merely in extending credit to businesses. Real, enduring power, he understood, resided in reorganizing, controlling, and ultimately owning those businesses outright. Morgan's first major strategic play was in the rapidly expanding railroad sector. Throughout the 1870s and 1880s, American railroads were a chaotic spectacle, hundreds of fiercely competing lines, relentless cutthroat competition, constant price wars, rampant overbuilding, and a seemingly endless string of bankruptcies. Most bankers wisely steered clear of these ventures, deeming them far too unstable and unpredictable. Morgan, however, saw not chaos, but immense opportunity. He grasped that whoever controlled the nation's railways would, by extension, control the American economy itself. Railroads transported everything of consequence, from vital coal and steel to essential grain, manufactured goods, and even people. Control the railroads, and you controlled commerce. Morgan's private library, situated at 36th Street and Madison Avenue. Morgan, then 70 years old, famously sat in a chair, calmly smoking a cigar and playing solitaire. One by one, the anxious bankers presented their institution's balance sheets. Morgan meticulously reviewed each one, assuming the role of arbiter of destiny. He decided which institutions would be granted a lifeline and which would be permitted to fail. For those he chose to save, he swiftly organized intricate rescue packages. He compelled healthy banks to contribute substantial capital, personally summoned John D. Rockefeller to deposit millions, and pledged millions more from his own fortune. And he made his terms chillingly clear: anyone who refused to cooperate would be permanently cut off from all credit. This was raw, unbridled power. Morgan was neither an elected official nor a government functionary, yet he was effectively acting as the central bank of the United States. His authority stemmed from his control over more capital and his sheer financial influence than anyone else in the nation. For 2 intensive weeks, Morgan orchestrated the comprehensive rescue. He determined which institutions would receive crucial liquidity, which would be merged into stronger banks, and which would simply be shut down. He famously saved the Trust Company of America and, under the guise of crisis consolidation, forced the acquisition of the Tennessee Coal and Iron Company by U.S. Steel, which he controlled. He further organized a massive pool of bankers to support the New York Stock Exchange, preventing its total collapse. By early November, the panic had subsided. J.P. Morgan had single-handedly saved the financial system. Yet, here's what most people overlook. While Morgan did not cause the panic of 1907, he unquestionably benefited immensely from it. When the dust finally settled, Morgan's banks had strategically absorbed their weakened competitors. He now controlled the steel, the railroads that shipped the steel, and the banks that financed both. This was vertical integration on a scale so grand that even the legendary John D. Rockefeller reportedly envied it. However, Morgan's true, profound genius wasn't simply in building businesses, colossal as they were. It was in his unparalleled ability to leverage financial crises as instruments to consolidate and expand his already formidable power. The most illuminating example of this stratagem is undoubtedly the Panic of 1907. The year is 1907. The U.S. economy, while booming, was precariously unstable. Banks were dangerously overleveraged, and trust companies, which operated with significantly less regulation than traditional banks, were engaging in increasingly risky lending practices. In October 1907, a speculative scheme in copper collapsed, sending shockwaves through the financial system. The Knickerbocker Trust Company, one of New York's largest and most prominent trusts, was abruptly exposed as insolvent. Panic seized depositors, who rushed en masse to withdraw their funds. The Knickerbocker failed. The panic swiftly spread to other trusts and banks. Long queues of anxious depositors formed, all demanding their money back. But banks, by their very nature, do not keep sufficient cash on hand to pay out all depositors simultaneously. They are fundamentally illiquid. And when everyone demands cash at once, the entire system grinds to a halt. This was a classic, catastrophic bank run. By mid-October, multiple banks teetered on the brink of collapse. The stock market was in free fall, and the entire economy was seizing up. Crucially, the U.S. government had absolutely no established mechanism to respond. There was no central bank, no Federal Reserve, no designated lender of last resort. There was, in fact, only J.P. Morgan. On the evening of October 24, 1907, the presidents of New York's largest banks and trust companies converged upon J.P. Morgan's private library, situated at 36th Street and Madison Avenue. Morgan, then 70 years old, famously sat in a chair, calmly smoking a cigar and playing solitaire. One by one, the anxious bankers presented their institution's balance sheets. Morgan meticulously reviewed each one, assuming the role of arbiter of destiny. He decided which institutions would be granted a lifeline and which would be permitted to fail. For those he chose to save, he swiftly organized intricate rescue packages. He compelled healthy banks to contribute substantial capital, personally summoned John D. Rockefeller to deposit millions, and pledged millions more from his own fortune. And he made his terms chillingly clear: anyone who refused to cooperate would be permanently cut off from all credit. This was raw, unbridled power. Morgan was neither an elected official nor a government functionary, yet he was effectively acting as the central bank of the United States. His authority stemmed from his control over more capital and his sheer financial influence than anyone else in the nation. For 2 intensive weeks, Morgan orchestrated the comprehensive rescue. He determined which institutions would receive crucial liquidity, which would be merged into stronger banks, and which would simply be shut down. He famously saved the Trust Company of America and, under the guise of crisis consolidation, forced the acquisition of the Tennessee Coal and Iron Company by U.S. Steel, which he controlled. He further organized a massive pool of bankers to support the New York Stock Exchange, preventing its total collapse. By early November, the panic had subsided. J.P. Morgan had single-handedly saved the financial system. Yet, here's what most people overlook. While Morgan did not cause the panic of 1907, he unquestionably benefited immensely from it. When the dust finally settled, Morgan's banks had strategically absorbed their weakened competitors. U.S. Steel had acquired the Tennessee Coal and Iron Company at a fire sale price, consolidating its dominance. Weaker financial institutions were eliminated from the landscape, and Morgan's power was now beyond any conceivable question. He had solidified his image as the man who saved America, the indispensable figure the government turned to in its gravest hour of need. However, the 1907 panic exposed a terrifying reality to both the American public and its politicians. A single private banker wielded more power over the national economy than the entire elected government. If Morgan had simply chosen not to intervene, the entire system would have catastrophically collapsed. The nation's financial stability, it seemed, rested precariously on the goodwill and decisions of one 70-year-old man. This situation was deemed utterly unacceptable. Consequently, Congress launched a series of investigations. The Pujo Committee famously investigated the money trust and, in its 1912 report, concluded with stark clarity that J.P. Morgan and a small, tightly knit group of allies effectively controlled the nation's credit through a web of interlocking directorates, strategic partnerships, and vast concentrated capital. The report explicitly stated that Morgan and his partners collectively held 341 directorships across 112 corporations, valued at $22.2 billion, a figure representing a staggering 25% of all wealth in the United States. Public outrage was immediate and widespread. The burgeoning progressive movement demanded sweeping reform, and the proposed solution was to establish a central bank that would ostensibly eliminate the need for private bankers to act as lenders of last resort. But here lies the profound twist. The central bank that was ultimately created, the Federal Reserve, was, in fact, designed by bankers. More specifically, it was meticulously crafted in a secret meeting orchestrated by Morgan's closest allies. In November 1910, 6 influential men traveled in a private rail car to Jekyll Island, Georgia. They famously used only their first names to evade recognition and public scrutiny. Over the course of 10 days, they diligently drafted a comprehensive plan for a central banking system. The attendees included Senator Nelson Aldrich, a close ally of Morgan and incidentally the father-in-law of John D. Rockefeller Jr., Frank Vanderlip, the president of National City Bank, a prominent Morgan bank, Henry Davidson, a senior partner at J.P. Morgan and Company, Charles Norton, president of First National Bank of New York, another Morgan bank, Benjamin Strong, vice president of Bankers Trust, yet another Morgan bank, and Paul Warburg, a partner at Loeb and Company, representing the powerful Rothschild interests. This was unequivocally not a government committee. It was a private banking cartel designing the very system that would, on paper, regulate them. The comprehensive plan they conceived became the Federal Reserve Act, which was ultimately passed by Congress in December 1913. On paper, the Federal Reserve was presented as a governmental institution, established to provide stability and eradicate financial panics. In reality, it emerged as a privately controlled central bank, fundamentally owned by its member banks. The Federal Reserve is structured as a corporation. It has shareholders, and those shareholders are private banks. The largest banks own the largest shares, and J.P. Morgan's banks were not only founding members, but also major shareholders. The Federal Reserve was granted the extraordinary power to create money and lend it to both the government and to banks. This was precisely the same power Morgan had exercised personally in 1907. Now it was institutionalized. The Fed would become the official lender of last resort. But who truly controlled the Fed? The banks. Morgan's banks. It was the ultimate embodiment of regulatory capture. The very bankers who stood in need of regulation were the ones who wrote the regulations and created the regulator itself. Now, allow me to demonstrate precisely how this system operates today and why you remain inextricably caught within its mechanisms. When the 2008 financial crisis erupted, the government and the Federal Reserve responded by deploying the exact playbook Morgan had perfected in 1907. The largest banks were immediately deemed too big to fail and subsequently received massive bailouts. Weaker institutions were coercively forced into mergers with stronger, more solvent entities. J.P. Morgan Chase, for instance, acquired Bear Stearns and Washington Mutual at fire sale prices, mirroring Morgan's absorption of competitors in 1907. The government and the Fed poured unlimited liquidity into the system to prevent a total collapse. The banks that emerged from the crisis were even larger and more powerful than they had been before. And critically, the executives whose decisions had contributed to the crisis remained firmly in charge, just as Morgan had remained in charge after 1907. Today, J.P. Morgan Chase stands as the largest bank in the United States, commanding a staggering $3.9 trillion in assets. It is the direct corporate descendant of J.P. Morgan's original banking house. Jamie Dimon, its current CEO, is frequently referred to as the modern J.P. Morgan. During the 2020 COVID crisis, Dimon was reportedly engaged in direct phone calls with the Treasury Secretary and the Fed Chair, coordinating the national response. Just as in 1907, private bankers continue to be the primary managers of financial crises. And just as in 1907, they invariably benefit from the very crises they manage. J.P. Morgan Chase, for example, received crucial Federal Reserve support to acquire First Republic Bank in 2023 when it failed. The same playbook, once again, crisis, consolidation, bailout, and then emergence, stronger than ever. Here's how Morgan's system continues to exert control over your life right now in 2026. If you have a mortgage, it is highly probable that it is held or serviced by a bank directly descended from Morgan's sprawling empire. J.P. Morgan Chase, Bank of America, Citigroup, Wells Fargo, all trace their lineage back to the early 1900s banking consolidation that Morgan spearheaded. Collectively, these institutions control a formidable 40% of all U.S. mortgages. When you make your monthly mortgage payment, a significant portion is allocated to servicing fees, interest, and principal. The interest, in particular, flows directly into these banks' coffers. Over a typical 30-year mortgage term, you will often pay 2 to 3 times the home's original purchase price purely in interest. This immense transfer of wealth from homeowners to banks is a fundamental component of the system Morgan so ingeniously designed. It is perfectly legal, universally accepted, and extracts trillions from American households every single year. Similarly, if you possess a 401k or any other investment account, that money is managed through the intricate financial system Morgan so robustly constructed. The fundamental structure of mutual funds, pension funds, and investment banks all originated from the widespread consolidation of the early 1900s. The various fees you pay, the management costs, the transaction expenses, all flow to financial institutions operating under Morgan's established model. The average American annually pays 1% to 2% in investment fees. On a $500,000 portfolio, this translates to an annual sum of $5,000 to $10,000. Over a lifetime, hundreds of thousands of dollars are discreetly transferred from your savings to Wall Street. Crucially, when the economy inevitably crashes, your 401k loses significant value, while the very banks responsible are invariably bailed out. In 2008, trillions in household wealth simply evaporated, stock portfolios plummeted by 50%, and home values crashed by 40%. Yet, J.P. Morgan Chase, Bank of America, Citigroup, and Goldman Sachs all survived. They received massive bailouts, unwavering Fed support, and explicit government guarantees. They emerged stronger and more entrenched than ever. You lost wealth. They consolidated power. This is the essence of Morgan's system. Profits are privatized, while losses are socialized. The banks win, you pay. Furthermore, the Federal Reserve's ability to print money inherently creates inflation. Inflation acts as a hidden tax on your hard-earned savings. If, for example, you hold $100,000 in cash and inflation runs at 3% per year, your purchasing power diminishes by $3,000 annually. Over a decade, you effectively lose $26,000 in real value. This wealth doesn't simply disappear, it subtly transfers to those who benefit from inflation, borrowers with fixed-rate debt and asset owners. Banks, being the largest borrowers, leverage this system perfectly. They borrow from the Fed at low rates and then lend at higher rates. The spread constitutes their profit. Your inflation losses become their gains. This is the very system Morgan helped engineer when his allies established the Federal Reserve in 1910. Now, permit me to illustrate the 3 pivotal moments when Morgan personally intervened to save the U.S. government, as understanding these events lays bare the true nature of his extraordinary power. The first bailout, 1895. President Grover Cleveland faced a profound crisis. The U.S. Treasury's gold reserves had plummeted below $100 million, which was the legal minimum required to back the nation's currency. Should reserves fall any further, the U.S. would be compelled to abandon the gold standard, leading to an immediate collapse of confidence, a mass dumping of U.S. bonds by foreign creditors, and an inevitable default. Cleveland desperately sought assistance from Congress, but his pleas were met with refusal. He was out of viable options. It was then that J.P. Morgan, accompanied by August Belmont, who represented the influential Rothschild banking interests, arrived at the White House. Morgan proposed a deal. He and his powerful banking syndicate would loan the government $65 million in gold in exchange for U.S. bonds. These bonds would be purchased at a discount, guaranteeing Morgan an immediate, substantial profit. Morgan would then resell these bonds to the public at a higher price, generating even more profit. Crucially, the loan was structured such that Morgan retained control over precisely when and how the gold entered the Treasury, thereby granting him significant leverage over government policy. Cleveland, with no other recourse, accepted. Morgan swiftly organized the syndicate, the gold was delivered, and the crisis was averted. Morgan personally reaped millions in profit. The pivotal lesson learned by everyone in power was clear. When the government found itself in crisis, its ultimate recourse was to Morgan, not to Congress, not to the voters. This event established a powerful precedent that would be repeatedly invoked in 1907 and again in 2008. Private bankers rescue the government and, in doing so, profit handsomely from the rescue. The second bailout, 1907. I have already described the panic of 1907, during which Morgan effectively acted as the nation's de facto central bank, making life-or-death decisions for financial institutions. However, there is one critical detail I omitted. During the height of the 1907 panic, Morgan himself was under intense investigation by the federal government for antitrust violations. His vast network of banks and corporations stood accused of constituting an illegal monopoly. Yet, amidst the chaos of the panic, Morgan engaged in direct negotiations with President Theodore Roosevelt. Morgan rarely granted interviews, never actively sought publicity, and meticulously operated behind the scenes. Most Americans in 1900 had little true comprehension of the extent of his control. They knew his name, certainly, but they utterly failed to grasp the depth of his power. And this, precisely, was how Morgan preferred it. Visible power inevitably attracts scrutiny and regulation. Invisible power, conversely, compounds quietly and unimpeded. In 1912, when the Pujo Committee began its investigation into Morgan, they summoned him to testify. Congressman Samuel Untermeyer famously questioned him, leading to an exchange that has since become legendary. Is not commercial credit based primarily upon money or property? No, sir. The first thing is character. Before money or property. Before money or anything else. Money cannot buy it. This renowned answer is often superficially interpreted as Morgan being a man of unshakable principle. However, it reveals something far deeper and, perhaps, darker. Morgan's immense power was not simply predicated on the vast sums of money he owned. Rather, it was built upon an intricate web of trust and relationships. Character, in Morgan's world, meant, asterisk, who do you know? Who implicitly trusts you? Who will take your urgent call in a crisis? Asterisk, Morgan controlled credit not because he possessed the most capital, though he commanded truly vast amounts, but because everyone implicitly trusted him to make the right, decisive call when it mattered most. And that profound trust bestowed upon him more power than any amount of mere capital could ever provide. Because in a true crisis, governments and banks didn't ask, who has the most money? They asked, who can organize a solution? And the answer, invariably, was Morgan. Allow me to illustrate how this exact dynamic continues to play out today. In 2008, as Lehman Brothers teetered on the brink of collapse, Treasury Secretary Hank Paulson and Fed Chair Ben Bernanke were not merely deliberating policy in government offices. They were constantly on the telephone with Jamie Dimon at J.P. Morgan Chase, Lloyd Blankfein at Goldman Sachs, and other prominent bank CEOs. These powerful private bankers actively advised the government on which institutions to save, which to permit to fail, and precisely how to structure the ensuing bailouts. Lehman Brothers was permitted to collapse. Bear Stearns was saved by coercing J.P. Morgan Chase to acquire it, albeit with generous government guarantees. AIG was bailed out, not coincidentally, because it owed enormous sums of money to Goldman Sachs and other major banks. This was not the government independently formulating policy. This was the government collaborating intimately with banks to design policies that explicitly protected banks. Exactly as Morgan had orchestrated in 1907. And why does the government invariably turn to the biggest banks during a crisis? Because these banks are, by design, too big to fail. If J.P. Morgan Chase were to collapse today, it would inevitably bring down dozens of other financial institutions in its wake. The entire credit system would freeze instantly. Mortgages would cease to be processed. Credit cards would become unusable. ATMs would quickly run out of cash. The entire economy would seize up and collapse within a matter of days. Consequently, the government has no conceivable choice but to save J.P. Morgan Chase. The bank understands this implicit guarantee. Jamie Dimon understands this. And that profound knowledge grants the bank enormous, undeniable leverage over government policy. This is Morgan's ultimate innovation. Render yourself indispensable, and then, and only then, dictate the terms. Herein lies the ingenious mechanism that renders this system inescapable. The largest banks are inextricably interconnected through trillions of pounds in derivative contracts. J.P. Morgan Chase, for instance, holds an astonishing $60 trillion in notional derivative exposure. Bank of America commands $50 trillion and Citigroup $47 trillion. These are complex financial instruments, effectively insurance contracts, interest rate swaps, and credit default swaps, all representing bets that banks make with one another. If just one major bank fails, it cannot meet its derivative obligations, which in turn causes the banks it owes money to fail, triggering a catastrophic cascade. This phenomenon is known as counterparty risk. It effectively means that all the major banks are, for all intents and purposes, operating as one single, colossal institution. If any one of them fails, all are threatened. Therefore, in a crisis, the government is compelled to save all of them. This is a system by design. Morgan understood in 1907 that if banks are interconnected, they collectively become too big to fail. Modern banks have amplified this exponentially through the sheer volume and complexity of derivatives. Now, let me address the prevalent conspiracy theories, as Morgan is frequently portrayed as a shadowy puppet master controlling every lever of power. This portrayal is fundamentally inaccurate and, indeed, obscures the true nature of the system. Morgan did not control the government as a dictator might. He did not secretly orchestrate panics from behind a curtain. He was, at his core, a banker who possessed an unparalleled understanding of leverage, information, and timing. He masterfully exploited crises that occurred naturally, using them as opportunities to consolidate his power. He did not create the panic of 1907, but he meticulously positioned himself to be utterly indispensable when it happened. And the system he built is not shrouded in secrecy. It means leveraging the system's various tools, mortgages, credit facilities, investment accounts, and benefiting from the perceived stability it offers, even if it comes at the cost of fees and inherent extraction. Most people gravitate towards this option, primarily because the alternative of constantly battling the system proves utterly exhausting. The second option is to minimize extraction. This strategy focuses on reducing your personal exposure to the system's inherent costs. It means consciously working to reduce debt, perhaps by paying off your mortgage ahead of schedule to significantly cut down on interest payments. It involves choosing low-cost index funds over more expensive, actively managed alternatives. It encourages banking with credit unions rather than major commercial banks, keeping only a minimal amount of cash within the traditional banking system. Furthermore, it advocates for owning tangible assets outside the direct purview of the financial system. Think gold, real estate, or even cryptocurrencies like Bitcoin. By adopting these measures, you effectively limit the system's capacity to extract wealth from you. The third option, perhaps the most audacious, is to position yourself within the system. If the extraction of wealth is an inescapable reality, then the logical, albeit somewhat cynical, approach is to own the extractors themselves. This means acquiring shares in banking giants such as J.P. Morgan Chase, Bank of America, or Goldman Sachs. If these institutions consistently profit from one crisis after another, benefiting from successive government bailouts, then owning a part of them ensures you partake in those profits. When wealth is inevitably transferred from taxpayers to banks by government decree, being a bank shareholder means you are on the receiving end. This approach is arguably amoral but undeniably pragmatic. The system is designed to concentrate wealth within these powerful institutions. Therefore, to thrive within it, one must own those very institutions. J.P. Morgan passed away on March 31, 1913, at the age of 75. He lived long enough to witness the passage of the Federal Reserve Act, the very institution his allies meticulously designed to perpetuate his enduring system of financial control. His estate was valued at a then staggering $80 million, equivalent to approximately $2.4 billion in today's money. Yet, his true influence far surpassed this personal fortune. When his will was read, John D. Rockefeller, reportedly worth 50 times more than Morgan, famously quipped, "And to think he wasn't even a rich man." But Rockefeller, for all his personal wealth, profoundly missed the point. Morgan's unparalleled power was not derived from his individual riches, it stemmed from his masterful control over other people's wealth. He held the reins of credit that financed vast railroad networks, sprawling steel mills, and entire nascent industries. He commanded the banks that safeguarded everyone's deposits. In essence, he controlled the entire financial system. And that system, as a whole, was worth infinitely more than any singular individual fortune. Today, J.P. Morgan Chase boasts an astounding $3.9 trillion in assets, a figure that surpasses even the gross domestic product of an entire nation like Germany. Bank of America commands $3.1 trillion, while Citigroup holds $2.4 trillion and Wells Fargo manages $1.9 trillion. Combined, these top four banking behemoths control in excess of $11 trillion. They represent the modern embodiment of Morgan's original empire, institutions that are simply too big to fail, too intricately interconnected to be effectively regulated, and ultimately too powerful to be truly challenged. Remarkably, with every successive crisis, these institutions only grow larger and more dominant. In 2008, they swallowed up their failing competitors. In 2020, they received substantial support from the Federal Reserve and expanded further. Just last year, in 2023, J.P. Morgan Chase acquired First Republic Bank. The pattern that Morgan so definitively established over 120 years ago continues to unfold relentlessly. You cannot escape J.P. Morgan's system. The very mortgage you hold flows through banks he fundamentally shaped. Your hard-earned savings are deposited in institutions structured precisely using his foundational model. Financial crises are still managed according to his strategic playbook. The Federal Reserve, an entity he was instrumental in creating, prints the currency in your wallet. And when the next inevitable crisis descends, government leaders will undoubtedly call upon figures like Jamie Dimon, just as they desperately called upon Morgan himself in 1907. This is because the system is not merely about individuals, it is fundamentally about structure. It represents concentrated financial power. It views crisis as an opportunity for further consolidation. It embodies government dependence on private banks and the too big to fail doctrine as permanent, ingrained policy. If this analysis has unveiled a system you had never truly perceived before, if you now grasp that the intricate banking structures governing your life were meticulously constructed by one man over a century ago, then we urge you to subscribe to this channel immediately. Because understanding the system, seeing it for what it truly is, represents the crucial first step. You may not be able to escape Morgan's pervasive banking system, but you can certainly see it. And seeing it, truly seeing it, changes absolutely everything. J.P. Morgan, in essence, engineered crisis capitalism, cemented the too big to fail doctrine, laid the groundwork for the Federal Reserve, and pioneered the concept of government bailouts for private banks. That profound and enduring system is modern finance, and you navigate it every single day. Welcome to Morgan's World.